In today's video, we're going to be talking about Howard Marks, a very successful investor who actually recently wrote a memo about sea changes. Well, basically, he's telling us there's going to be a complete big transformation in the stock market. And we're going to be telling you guys our thoughts on it. What is he actually saying? It's a very, very long article, but we're going to be summarizing it for you.
Now guys, if you're really interested in building a 6 to 7 figure portfolio, we've got the perfect solution for you. Head over in the comment section or the description to sign up for our free masterclass where you can get all these proven steps to achieve it.
Okay, MJ.
Yeah.
This is a long article.
Yes.
But
we highlight some of the important ones.
Yes, thank you for highlighting all of these
They're
points.
all important, but here's what I think are the most important ones.
Right, okay, so I see this highlighted point, and I believe Howard Marks also talked about this quite a little bit.
Yes.
It's about the Nifty 50.
Yes.
So what is it about and why is it important?
So during the 70s, a lot of fund managers said that as long as the company is good, high quality management, high returns on capital, all that, buy. Just buy, close your eyes, you do well.
Right.
And for a while, it did well, but then it didn't do well. It crashed. Now, this is very similar to the environment today, where you have a lot of great companies dropping 50, 60, 70%. Right?
Yep.
Even the great Apple has dropped more than 20%. So why is this important thing that Howard Marks brought up is because ultimately as investors, it's one thing to figure out what the fundamentals of the company are. Another thing is to actually buy it at the right price.
Right.
Right. So, I mean, back in the day, McDonald's, right, was in the Nifty 50 era in the 1970s, they were a growth stock.
Yep.
Because a lot of places around the world didn't have McDonald's.
Yeah. Actually, they're still considered as a growth stock, right? I mean, look at their valuation.
Growing, but they weren't growing nearly as fast.
Right.
Back in the 70s, I believe there was no McDonald's. Yeah. And if you ask your parents and all that, it was an event when the first, first McDonald's store opened to them was like, I don't know, the first Taco Bell opening here or some other brand, right?
Right.
That was back in the day. So, as he said, right, if you held them all the way until 1974, a lot of these stocks, right, you are sitting more on 90% losses. So it's a great lesson to remember. And that's why never look down on companies that don't have the best products or even don't have the best managers. Because if the price is so low, it can still be a good investment. I think that's one of the key things. And to be fair, in the past, right, our channel was centered around that.
Yep.
But I think recently in the past, 4 to 5 months, we want to emphasize the point that really like great companies are fine, but great price is also very, very important.
Yep. I 100% agree on this statement. Okay. The second one, this is a bold statement.
Yes.
So he said that now investment managers actually buy bonds of almost any quality.
Yes.
As long as they are adequately compensated for the attendant risk. So, what is this about?
Correct. So, because of Nifty 50, people back then realized that you need to also recognize the importance of price.
Yep.
The lower your price, the lower your risk. So, the mind shift that they had back then is, okay, now we look at the reward and the risk. So he gave the entire description below, but when he was buying bonds back in the day, when he started off, bonds are typically considered safe.
Yes.
Right? And even within bonds, you have investment grade bonds, AAA rated, the Bs and all that, right? What he's saying is that there was a way, and this is the first sea change that actually happened in the financial markets, according to him, is that now you can actually buy lower quality stuff if the price is even lower. right? Because they learned from the Nifty 50s. And so that was the first big sea change. Yes, the reward might not be that great, but the risk is very low.
Right.
So you go for it.
Again, it's a margin of safety concept. Your risk is already taken off. It's so low already. I mean, it's like,
correct.
How low can it go even further?
Another famous investor, Seth Klarman, said that every asset in the world, and he means it, every asset in the world can be a good investment at the right price. Right?
Yep.
So it's like you wouldn't buy a Lambo for 500,000.
Yep.
But if today someone offer you 100,000, you take it, right? You borrow money if you don't have the money.
Yeah, find a way to buy it.
Right? Because you know someone else is going to buy it for 500,000.
Yep. Okay.
So that's the basic idea. That's the first sea change.
Okay. So the third point we have here, I see the title here right there,
Yes.
the incredible tailwind. So he mentioned that there is a few factors that give investors success over the past 40 years. So they see that there's a major contribution from economic growth, and preeminence from the US, the incredible performance of the greatest companies, gains in tech, productivity management techniques, and the benefit of globalization. And also, he's actually quite surprised that if 40 years of declining interest rate didn't play the greatest role of all. Actually, that makes a lot of sense.
So what he's trying, or at least my understanding of what he's trying to highlight here, is that when trying to explain what has happened in the past 40 years, and if you zoom into the 13-year period between 2008 to 2021, as much as we like to say we've got the US has great companies like Amazon and Microsoft and things like that, and yes, the economy for US is booming. Yes, technology there's a hype, but the biggest driver is interest rates, and this is very important for people like you and I, and even for people who are entering the market right now who have been only started investing in the past 10 years. And that is, we have only lived in the kind of interest rate environment that is low.
I 100% agree. I mean, when is the last time you can actually buy the largest ticket item, which is a house, at a actually pretty super close, I mean, like close to 0% interest rate in 2020?
The US, it was
USR, yes.
But of course, they're paying more than that because banks need to make money.
Yes,
they can't
correct,
be charging what the federal...
the BLR rate.
Yeah. So it is very low. And so later on, you will see what has this resulted in, and the things I highlight later on. But guys, before we move on, if you're someone looking to level up their stock investing skills and you need a lot more guidance, we do have a one-on-one program called the Mentorship Program. If you're interested, you can apply it in the comment section or the description.
Okay, so let's have a look over here. Okay, so this is the effects that
of these low interest rates. Okay,
so
now there's quite a lot, but the two that I want to highlight is that the first one is that they reduce the prospective returns investors demand from investments they are considering, thereby increasing the prices they'll pay. Okay, what does this mean? If money is cheap, which is what interest rates are, it means you can throw things around more, right? When you throw things around more, the prices of things will go up.
Inflation,
right? So that leads to the second point, which is the asset values go up. And of course, because borrowing cost goes down, right? Because now money is cheap. So I just borrow, I buy assets.
Yes.
So one of the interesting thing about 2008 to 2021 is that the amount of money printing was crazy. In 2020, the US printed 40% of its total money supply. If you add 2008, it's north of 50-60%. Now, if you think about it, right? If I print so much money, by right, inflation should happen.
Yes.
Right? Now, you ignore 2022 first, when interest rates were going up. This is the irony, right? So, in that 2008 to 2021 period, if there's so much money around, where is the inflation? In fact, in Malaysia, for example, from 2013 onwards, the property sector is rubbish.
Yeah,
Hasn't done
fair
well,
enough. Yep.
right? Because property prices don't go up.
Yep.
Right? Food prices, of course, they go up, but relatively stable. Nothing like 2022 when interest rates went up, right? Why? Because all the money went into assets, into stocks, into certain high-end properties, yes.
Right. That's why you see there's a pump.
Yes, especially in stocks, in financial, crypto, that's another one.
And now there's a dump.
Now there's a dump. So this is very important, going back to the first point, right? Is that people now will loosen their standards for investments. And so last time, right, if you think about it that way, I'm guaranteed, let's say 5% from the bank. So I need to go out and find an investment that's going to give me more than 5%. Now, if you're in Malaysia, the only thing that's guaranteed to give you more than 5% is EPF, by and large, right? So people are strict. People are like, I have to be very, very careful what I invest in. But if it drops to 1%, 3% looks good, right? So that's really what he's trying to get at.
Right. Okay. Pretty complicated, but you simplify it a lot. So I think it should be easy for all of us to digest. I mean, I also can digest pretty well. Okay, so this is another point. It's about the market strength encourage investors to drop their crisis inspired.
It is. Yeah, he's basically talking about crypto and a lot of growth investing tech stocks, right? But so that's like the rational brain of now the interest rates drop 1%. I need to find something. I don't have to find something more than 5% anymore. I can find something at 3%. So that's more like how a rational investor would think about things.
Yep.
However, in the market, because market is not always rational, FOMO became a big thing, right? Because guess what? Suddenly our money is very easy. So you see pumps happening all the time. So you see pumps happening all the time and you don't see your portfolio pumping, what are you going to feel? You're going to feel like, when is it my turn? You know?
Remember NFT was a thing?
Yeah. I have to do something, I can't be, I know I'm susceptible to it as well, definitely. So it's really an extension of the previous point.
Yep. Okay. That's actually pretty interesting.
So so the next bit is about the language, how they've changed, how these are some of the things that the mindset, this admittedly is a subjective take, but it's the mindset of people. So last time Fed behavior is highly stimulative, now it's tightening. Then inflation is dormant. Now it's 40-year high.
Wow.
Things like that. FOMO, last time FOMO, now the biggest concern is, will I lose money or not? And we can actually see this, right, in the market, in the business that we are in as well. So it's not really much here, but I thought it's an interesting table, qualitative table to show, right? Interest rates lowest ever, more normal, things like that.
Yeah. It's a very, very interesting term that they actually changed the narrative, the tone of narrative.
Yeah.
Okay. So this is what Howard Marks thinks, is it?
Yes.
In contrast.
This is what he thinks will essentially happen. And I agree a lot with it. He believes that inflation will abate, meaning it will not be as high anymore, because there was a lot of pent-up savings. His word savings, I call it demand, whatever.
Okay.
There's a lot of savings that people had, but now it's dwindling, right? Because now you can actually spend now, right?
Yes.
Compared to COVID. And
correct.
There's only so much money you have in savings. In 2 years, it's very easy to spend all your savings in 2 years, just say. But what is interesting is that even with all these things happening, the labor market is still very tight, meaning it's good, and wages are rising. So the economy is still growing. However, because of globalization being reversed, deflation will be difficult.
Oh, okay.
Yes. Deflation will be difficult for prices. So because people tend to think that all goods and services go up, that's not true, right? If you think about it, something like your TV doesn't inflate, right? It actually either stays priced, but the quality goes up like brand. Like Netflix, for example, it's always been like 50, 55 ringgit, but always new content coming in, right? So there are a lot of things that are actually deflationary. Tech goods are the classic example. However, with globalization, that may not be the case. Like it might actually still go up. So what he's trying to say is that, the inflation situation, right, is not easy. Or is it like going up? Or it's going up because of this factor? Or it's going to go up because of this factor? What he's saying is that there are several factors and they can work in opposite. And so you have to figure out all the factors, how they are moving, and figure out which one has a net momentum upwards. Okay. So what it means is that basically he doesn't think, and later on you see, he doesn't think that inflation will be as crazy as it is today, but it will not fall back to the past, what we were experiencing in the past 10 to 12 years.
Oh, okay.
That's what it means. Because now inflation is 7% in the US, give or take, right? For the market to be as vibrant like 2021, it needs to drop back down below 2%.
Yep.
But he's saying because of so he's saying it will continue to drop,
but they will reach to a point where
Yes.
it will normalize.
Yes.
Then that will be our new
Correct.
norm of
So
inflation.
it will not stay at 7% that high. It will drop because people's spending will be reduced.
Yes.
However, it will not drop massively because of deglobalization and the fact that people are the wages are rising. So when wages rises, inflation will happen.
Yes.
So you see, the complication is like there's one down up. So it's
they're pushing out each other.
that's how to think about it. And that's why he says here it's unlikely, right, for the Federal Reserve to become stimulative.
Oh.
But they will not be aggressive anymore. They will slow the pace. So they're likely to keep it at 4%, maybe 5%. And the word he used is neutral interest rate.
Right, funny thing. So what the Fed's target of keeping inflation down to 2% may not be achievable if that is what Howard Marks' narrative is trying to tell us.
Yes.
It will be higher than that, and that will be the new.
So that's why he thinks it's likely to average, right, to 2 to 4%. That's what he thinks. But he also reminds us that really 2 to 4, like the interest rates today at 4% is
still,
it's by historical standards.
Correct.
And if you think about it, if we are expecting inflation to be 2% or 3%, let's say, we should, maybe closer to 4%. We would like to think interest rate should be at 4%. So at least the economy and the people as a whole can keep up with their lifestyle-ish.
Right.
But as usual, it's very complicated, as you can see.
Macro stuff is okay.
Right. So anyway, he said that essentially interest rate is not going to decline. And we're unlikely to see the same optimism. Now, here's where it gets very interesting. Thanks for staying all the way. Because here is what he thinks is going to be the way forward for investors.
Okay.
And this is something I really agree with. And that is, investors, now onwards, can get solid returns from credit instruments, so bonds and things like that, which which really sunk the past decade.
Yes.
And will no longer have to rely on riskier investments to achieve their targets.
Wow.
The return targets. Lenders and bargain hunters, hint value investors, will face much better prospects in this change environment than they did in 2009 and 21. So this is his big sea change that he's talking about, that there's going to be a reversal. When money is cheap, silly ideas can make good investments.
Yep.
But when money is not cheap, rational ideas will start to make investments.
Which actually, is there any more points after this? Okay.
Oh, the last bit here is that always remember, guys. And this is to my growth investor friends out there. I'm a big fan of growth, obviously, but please note that what works
Yeah, it
in the
won't.
past 10 years
It doesn't work in the future.
are unlikely to not work.
Yeah,
in the
actually, the reason why I asked this is the last segment, because this is actually a good segment to actually go to our FIRL Pro.
Yes. Yes.
Yeah. So FIRL Pro, if you are wondering how we actually achieve,
If you want to figure out rational investments,
yes,
this is the place to be.
correct. And if you notice why our returns are actually,
Pretty decent.
pretty decent, is because the stocks that we pick are all very cheap valuation.
Yep. Yes, exactly that. Bargain hunting.
Yes.
And we are very rational about what we do. The reports that we produce, we like to think are very rational. So if you're that kind of person, if you like to see the rationale for why we do things and why we put certain things in the portfolio, head over and check out a free sample, right? If you're not super convinced yet, still not convinced after checking out the free sample, just send us an email to hello@firl.co, or you can just
DM us on our
Instagram,
Facebook,
things like that. Facebook.
Yeah.
We'll be happy to answer.
Yep.
Anything else?
Yep, nothing much, but thank you, MJ, for sharing what Howard Mark thinks about 2023 and potentially in the future. I hope you guys actually,
things I agree with.
Yes, I hope you guys actually learned a lot from today's video. If you did, make sure you smash the like button, hit the subscribe button, all those good stuff as usual.
Yes.
Don't forget to follow us on our social media, Instagram, Facebook, Telegram, all those good stuff. Links are all in the description below, and we'll see you in the next video.
Peace.